If your loan is coming due in the next year, yet nothing feels wrong now, that's exactly where it can cost you hundreds of thousands of dollars. A few years ago, I was talking to an owner and he sounded calmed because not stressed, the property was bringing money, rent was coming in, no emergency repairs, and then almost casually, he said, oh, the loan is coming due next year. Nothing went wrong, and that's exactly why it did. So if your loan ends in the next year and nothing feels wrong, this is for you. And if you're watching this and real estate still feels a little confusing sometimes, you're in the right place. So picture this. You own a rental property, it's running smoothly, rent is coming in on time, nothing is broken, and then you suddenly remember, oh, the loan on this property ends in about a year. Not tomorrow, not next week, but in a whole year. So everything seems fine on the surface, and your brain tells you you've got time. But waiting doesn't make the decision disappear. It just makes it more expensive, because when the loan ends, the property does not care what you meant to do. It only cares whether you decided early or late. And early is when you still have choices and power. If this is you, you might be thinking, well, worst case, I'll refinance. Rates will probably be better by then. If I need to, maybe I'll even put in my own cash and reset. And here's the part people don't see coming. The closer you get to maturity, the less flexible everything becomes. Not because lenders are cruel, but because they make decisions based on math, like how much money the property makes versus what you own. And rules tighten when time runs out. When a loan comes due, there are only three real choices. You either refinance, sell, or you bring in cash, meaning you either write a check for the whole amount due, or you get a new loan and write a check for the difference between the new loan the bank approves you for and the one that's due. The mistake one could potentially make isn't choosing the wrong path. The mistake is walking towards the path because it feels comfortable, without checking whether it actually works anymore. So, before we talk numbers, I want you to run 3 simple checks and ask these questions. Question number 1, if you didn't already own this property today, would you buy it at today's price at today's rates? Not because you have fond memories of when you first bought it, but today, because owning something doesn't automatically make it a good decision going forward. Question number 2, if you refinance, what does it actually improve? Does it improve your cash flow, and does the future generally look different? Or does it just buy you time? Question number 3, if you pay off the loan with your own cash at the maturity date, what are you really paying for? Are you paying for future growth or immediate relief? Because relief feels good, but in the long term, it can cause more damage than good. Let's see how this plays out in real everyday example, so you can picture it in your own life. A 12-unit apartment building somewhere in the Midwest was bought in 2019 for about $3.2 million. The loan, let's say, was roughly $2.4 million. 5-year fixed, interest rate was about 4%. At that time, the deal worked. And this isn't some glamorous story you'd share at the parties. It's the kind of quiet, hardworking property that everyday investors like you and I might own. And that's exactly where these situations can blindside people. So after expenses, the property made around $185,000 a year. Loan payment was about $142K. There was lots of breathing room. So the plan was simple: small rent increases over time, steady operations, and refinance later. And here's the key part: nothing went wrong. So fast forward to today, income is up. Fantastic. After expenses, the property now makes around $205,000. On the surface, it's a big success. But here's the part that surprises people. Higher income does not guarantee a refinance, because at today's rates, call around 6.25, the new loan payment now jumps. Debt service moves closer to $190,000 a year. And that higher loan payment shrinks the cushion that you thought you had. The lenders don't debate that cushion. They either accept it or they don't. So when the loan comes due, the payoff amount, let's say, of what's left on the loan is $2,150,000, but the new loan that the bank might approve you for is only $1.9 million. So that leaves a gap of about $250,000. And this is the moment most people never modeled for. It's the future that's not failing, but just almost working. And here's where you have three choices: turn real. Choice number one, refinance, which refinancing simply means that you replace your old loan with a new one. That is it. When you refinance, you're paying off the original loan, you're taking on a new loan. However, refinancing only works if it actually improves a deal in some way. Maybe it lowers your monthly debt payment, maybe it gives you a better cash flow, or extends the period of time before the loan is due again. Let's think 10 or 15 years. Choice number two, sell. Selling is the option people avoid because it feels like quitting. But selling before pressure shows up isn't failure, it's control. And at 12 months out, you still have options. At 6, it's fewer. 90 days, you're not asking anymore. You're not negotiating, you're begging. And if you wouldn't buy this deal again today, selling isn't emotional, it's very logical. And choice number three, bring cash. Writing a check for that $250,000 in our example feels very responsible. It feels like you're protecting what you built, you're protecting your asset. But pause and ask yourself, is this cash creating real growth, like funding property improvements that will boost rents? Or is it just mostly easing your worry? The truth is, most multifamily property owners don't actually have a refinancing problem. The problem is whether the property value still makes sense in today's world. Optimism or waiting for better days won't fix that, because clear actions will. So if your loan is due in 12 months, here's a simple, pressure-free plan to feel more in control. First 30 days, gather all your numbers, no sugarcoating. You look at your actual income minus expenses, run the loan payments at today's rates. Next 60 days, chat with lenders and quietly explore what buyers might pay for the property. It's not committing, sort of like getting the facts and know your true options. By 90 days, decide with confidence, refinance it if it truly helps, sell to keep control, or add cash if it builds real value. Because waiting isn't neutral. It's actually a choice that you make to lose leverage. And if your plan only works under perfect conditions, not a plan. Because that does not reward hope, it rewards clarity. All right, guys. Drop your comments below. Tell us, is there a deal that you're looking at right now whether you're considering refinancing or selling or maybe bringing your own cash? Let's talk in the comments, and we'll see you guys on the next one.